Today we are going to start third chapter in your syllabus, behavior of production process and different market structures. We have to consider now types of businesses that can be seen in a country. Of course, there are different categories under private and public sector. Of course, private sector means individuals or group of individuals who use factors of production in order to make goods and services for the purpose of profit. So here, private sector mainly concern profit, but the government sector, even they use factors of production, they do not have a target called profit always. They may have some other objectives too. Anyways, number of businesses we can realize in the market. So very basic stage of the private sector is sole proprietorship, if not sole trader. Simply a single firm, a single owner runs a venture. So then partnership as a second stage. In here, few partners, in other words, number of 2 to 20 actually, owners are involved in order to run a business. It is called a partnership. Then the incorporated sense, it is another, we can say somewhat personal, there's a personal recognition or separate personal legality. In other words, we realize there are a number of companies like private limited and public limited. That's how we consider incorporated. Thereafter, cooperative organizations. These are also private sector. This may not have a target called profit. They may do concentrate some other objectives like we can say achieving their wealth for members, achieving particular target for members. We can say retailers cooperative, wholesalers cooperative, like that. As well as government sector, there are state enterprises, especially corporations, are government sector businesses, right? So in the beginning, we will understand number of organizations that exist in an economy. So these businesses may have a production function. Production function sense, they use number of resources. Simply they organize factors of production such as land, labor, capital, and they make goods and services. Sometimes there are businesses, there are distributors. Just they purchase goods from a wholesaler and redistribute to a redistribute to a consumer. Sort of an intermediary. But in this topic, we learn producing or production firms. So it says very beginning, production firms, a firm that combines factors of production to produce goods and services with a view to fulfilling the human needs and wants in an economy is referred to as the production or business organization. Production organization of different nature exists in an economy, and these could be categorized as follows. So first four goes under private sector. The last one falls under the government or the public sector. Thereafter, objectives of a production firm. In here, objective sense, particular targets. Actually, the target of the production firm is to make goods and services. Their target is to make goods and services. So then, number of resources are organized as I told you before. Then there are major resources in the production process called variable factors and fixed factors. Fixed factors. So variable factors are things which are involved in the production. It does vary with the level of output. In other words, many or there with more and more resources are variable resources are combined. Of course, a larger quantity can be achieved. When there is no production, no need to use any variable factor. That's what variable factors function actually. So variable factors in a production organization, workers are the major variable factor. If many workers are employed, they will produce a larger quantity. If they employ less workers, less quantity can only be produced. That's how variable factors, uh, work. Then the next one, fixed factor. In here, businesses or production organizations may use machines, buildings as fixed factors. In here, business should purchase those resources very beginning of the production. If they do not have those fixed factors, the production cannot be done. If there are fixed factors like buildings and machines, of course, production can be done smoothly. As well as if the production is not there, or still the firm didn't make anything, but firm should have or firm should purchase fixed factors necessarily beginning of the production. You see, that's how fixed factors work. Then you are given equation. Quantity, simply Q, in other word output. It is a function. That's what F represent here. Or quantity depends upon labor and capital. So labor and capital are variable and fixed factors respectively. So what does this equation imply? Quantity or the output of a firm depends upon labor and capital. If there are more labor, more capital, of course, left side of the equation would be high. In other words, quantity is somewhat high. If labor and quantity, labor and capital is less, the left side of the equation, quantity even less. Likewise, so this is the way of recognizing production function of a business, as well as it says objective of a production firm. Although the major objective of any production organization is the profit, the difference exists in the level of profit expected by each manufacturing organization. The process that converts factors of production into goods and services is referred to as production. Here, factor inputs are transformed into final products through a certain technical method, and the technical relationship that exists between factor inputs and the final output can be shown by using the following equation. So the equation, simply the relationship between quantity of output and the number of inputs. Simply quantity of output is a function of input. That is the meaning. The above equation shows the output Q is a function of factor inputs, labor and capital. It is possible for the producer to change the output by changing the amount of labor and capital used. Here, it is possible for the producer to change some factor inputs within shorter time period. Of course, some factor inputs it is not possible to change within shorter time period. Therefore, how the final output can be increased or decreased depend on the speed at which simply total output of a business depends upon uh, factors which are employed by the organization. So then we look at the next one. It says that producer can change the factor inputs. In other words, time taken by the producer to change the same. Depending on the time taken to change factor inputs, production categorized short run and long run. So here, factors of production which are used for the in the production process, of course, can be changed time to time. Based on it, time periods are categorized short run as well as long run. These are two periods based on factors of production that the firm uses. In the short run, uh, firm anyways want to increase its production continuously by employing factors of production. There are two factors, as I told you, variable factors like labor, as well as fixed factors like machines. In here, we notice capital, technical term for every fixed factor. So, under the short run, the firm may employ both factors, but fixed factors such as capital is assumed to be held constant. Fixed factors are held constant while other variable factors are increased in order to increase the production. It is called short run. So once again, short run is a period where output of the firm is increased by increasing variable factors, while fixed factors like capital are assumed to be held constant. So then it says the short run production is the time period within which at least one factor input remains fixed. So one factor remains fixed, since here capital. In other words, time period which at least one factor input cannot be changed. In the short run, production exists. There exist both fixed and variable inputs. In the next one, long run. So in the long run, of course, production is increased as usual, but the firm increases all the factors, as I told you, fixed factors and variable factors, in order to increase the production. It is called long run. So in the long run, all the factors are variable, no more fixed resources or factors like capital. Simply everything is changed. Then we can't say specifically a time where the firm does move to long run. I mean, we can't apply this one to a calendar, what we use. We can't say exactly within a month firm will switch to a long run. After 6 months, firm will switch to a long run. It is impossible. It depends on the situation where fixed factors are changed. Whenever the fixed factors are changed, it is called long run. Anyways, we know very well, very beginning of the producer, of course, in the short run. So the firm will use resources for the production, especially machines, buildings, just started. So at the time being, fixed resources are constant, but the firm may employ many workers to increase the production. After certain time, the firm may purchase another building, another machine, this and that. If so, the firm now operates its production in the long run. That's how we realize the difference between short run and long run. So it says the time period that necessary to change all factor inputs used in the production is referred to as the long run. In the long run production, all the factor inputs are variables. The long run in the production is the period necessary to convert fixed factors into variable factors. What does last sentence mean? There are no fixed factors so far. All the things are variable because the firm use all the resources are changed in order to increase the production. But in the short run, they only change or only increase number of variables, but capital is held constant. So after discussing the difference between short run and long run, we just start production cost. Especially we do start production cost by using two words here. If someone spend money for the production of goods, a businessman would have employed money use money to buy some stuffs for production resources. So it is called financial expenditure. In other word, direct cost. Direct cost. For example, there was a person who was employed. He was employed in an organization. For 50,000 rupees. 50,000 rupees. 50,000 rupees. This is the wage he received as a worker. Later on, he thought to be an entrepreneur instead of employee. Then he decided to leave from the job. If he sacrifices the job, necessarily 50,000 is forgone. As we studied the term opportunity cost. Now he started a business. He wanted to buy capital, I mean fixed factors, for 100,000. We just take, he just purchased fixed factors for 40,000. As well as he purchased variable factors. That means resources, I mean raw materials and workers, variable factors. 10,000. This is the total cost he spent for the production of goods. Then the total expenditure, of course, 50,000. Actually, the 50,000 is called direct cost. Direct cost. If not explicit cost. That means a money which is spent on purchasing of factors. There is a clear financial outflow. There is a clear financial outflow. Meanwhile, he lost 50,000 from the employment. Actually, this is called opportunity cost, if not indirect cost, as well as implicit cost. So the implicit cost or indirect cost are opportunity cost. Actually, once he start a business, he spent 50,000 only. There is a clear financial outflow, but indirect cost means not a financial loss, but opportunity cost. He feels once he start a business, he lost money from the employment, then altogether economic cost sense, economic cost of the business. Economic cost of the business is direct cost plus indirect cost. So in here, 50,000 direct cost as well as 50,000 indirect cost. total becomes 100,000. This is called economic cost. According to the economist point of view, actual cost of the business is 100,000, not the 50,000. If we look at economist, we can say accountant point of view, accountant never concentrate opportunity cost. When you make income statement, I mean profit and loss statement, or the statement of financial position, you do not add opportunity cost. It includes all financial expenses what the business has incurred. Right now, economists concentrate both explicit and implicit cost. Therefore, economist cost of production is always greater than the accountant cost of production when there is an implicit cost of the production. So it says there, the monetary value of all factor inputs, or in other words, the production factors utilized in the production process of an item is identified as production cost. The value of best alternative production that could be produced utilized in the same resources utilized in the production of a given item is referred to as the opportunity cost of given production process. Therefore, the opportunity cost of all resources used in the production process of an item can be identified as production opportunity cost. The cost item related to the production opportunity cost can be classified as direct and indirect cost. The monetary value of factor input purchased externally by a firm is referred to as direct cost. Wages paid to laborers. Money spent in purchasing raw materials. These are examples for direct, simply financial, and explicit cost. The opportunity cost of production resources. The resources owned by a given firm utilized in the production of an item is referred to as indirect cost. The component of indirect cost can be stated as follows. The wage foregone. Next one, that's the example even I took. Normal profit, economic depreciation, interest foregone by the producer. I just cut economic depreciation. The economic profit, it is a sort of indirect cost. We will consider economic profit in the next unit. Interest income foregone by the producer. Simply, he would have saved 50,000 at a bank. Then particular rate of interest can be taken. What happened now, once he invested money in the business, he lost the interest rate that he would have taken from the money saved. So it is an opportunity cost. In other words, implicit cost or indirect cost. Right. That's what it says next as a next one, accounting profit and economic profit. Accounting profit, of course, profit means total revenue minus total cost. Economic profit means as same total revenue minus total cost. But accounting profit is lower than the economic profit. Why? When cost of production is calculated, the accountant doesn't take indirect cost, simply opportunity cost. But the economists consider explicit cost and implicit cost, direct and indirect. So economist cost of production is greater than the accountant cost of production. As a result, accountant profit is somewhat bigger than economist profit. You see, what is the reason here? Accountant does not take into account indirect cost, I mean the opportunity cost, when the production cost is calculated. But the economist calculate both explicit and implicit. Another word, direct and indirect cost. So economist cost of production is somewhat bigger than the accountant cost of production. When the profit is calculated, profit is calculated by comparing total revenue and total cost. Total revenue is common in both cases, but accountant production cost is lower than the economist production cost. Therefore, accountant profit is bigger than the economist profit. That's what next one implies. Accountant only considers the cost, or in other word, out of pocket expenditure as the production cost. Accordingly, accounting cost equal direct cost. Accounting profit is calculated by subtracting direct cost of a firm from total revenue. So the accounting profit means a total revenue minus direct cost only. But economist or economic profit means total revenue minus direct cost as well as indirect cost. Right. So this is how we illustrate profit. Total revenue minus direct cost as well as indirect cost from the total revenue. Then economics profit is lower than the accountant profit. And out of this, there was a question regarding what is meant by complementary good. Complementary good, one student wanted to know, actually complementary goods are couple of goods what we purchase together for the maximum satisfaction. So car and petrol are complementary goods. Tea and sugar are complementary goods. So simply definition sense, a couple of goods that the consumer purchases for the maximum satisfaction. Couple of goods. For example, if you need a television to watch, need television, electricity, cable TV, I mean satellite or something, as well as you have to pay for it, regular connection also there. Many things together. If so, you will have satisfaction. That kind of goods are called complementary goods. Right. In the next one, you are given an example. A firm produces 800 units of an item, the total price of which 20 rupee. The firm has to spend 2,000 rupees, raw materials 1,000, wages 400, electricity and fuel and 500 to settle interest payment for loan obtained. These are examples of cost.